Today, inequality rules, or how the other half lives. Hello again, it's Martin North from Digital Finance Analytics, working at this post covering finance and property news with a distinctively Australian flavour. The ABS last Thursday released their latest finance and wealth data to December 2020. They reported that the total household wealth increased 4.3% or $501 billion. That's the highest quarterly growth rate since the December quarter of 2009. Total household wealth and wealth per capita were at record levels of $12,033 billion and $467,709. The ABS said that the December quarter growth in household wealth was driven by rising residential property prices, reflecting record low interest rates, support through government programs such as the First Home Buyer Scheme and the Home Builder Scheme, and also pent-up demand from buyers. Residential assets contributed 2.2 percentage points to the quarterly growth in household wealth, followed by superannuation balances and directly held shares at 1.4 and 0.5 percentage points. Through the year, household wealth grew 7%, which was slightly below the long-term average of 7.3%. Residential assets rose 7.7% or $528 billion through the year, with property prices contributing 6.1 percentage points to the growth. The growth in residential assets was seen across both owner-occupier and investor housing in the December quarter. Owner-occupied housing loans grew 1.9%, which was the strongest growth seen in 4 years, while investor housing loans grew 0.4%, which was the first positive growth recorded in the past 2 years. Household liabilities increased 1% or $24 billion, driven by a $20 billion rise in housing loans and a $1 billion rise in short-term debt. The growth in housing loans reflects the increased activity in the property market over the quarter. The rise was mainly driven by owner-occupied loans, which increased a net $21.8 billion, while investor loans also rose $2.6 billion, and that was the first positive growth rate since December 2018, although it's worth noting, of course, that many people did also pay down their loans, so these are net movements. Credit cards were the biggest contributor to the increase in short-term debt. Positive growth this quarter follows on from 3 consecutive quarters of falls. The increase was supported by the easing of lockdown measures, boosting consumer confidence and encouraging households to spend. Growth was particularly strong in November and December, coinciding with strong retail spending figures due to the Black Friday sales, as well as activity during the December holiday period. The housing debt-to-income ratio decreased from 139.2 to 139 over the quarter, as growth in income at 1.2% was greater than the housing debt at 1%, and the ratio has fallen for the past 4 quarters, recording a 2.5 percentage fall through the year, which is the largest fall since 1990. The recent growth in income was driven by government income support packages implemented in response to the COVID-19 pandemic, including JobKeeper and the coronavirus supplement. After drawing down on existing lines of credit in March 2020 quarter, private non-financial businesses have reduced their loan balances for the 3 consecutive quarters, with total loan liabilities falling below pre-COVID levels. Private non-financial businesses have turned to the equity markets to access capital, issuing a net $70.9 billion in equities through the year, and that resulted in the lowest debt-to-equity ratio at 0.48 since the March quarter of 2005. Now, it's worth thinking about these figures in more detail. The ABC said that the recession was great for some Australians despite the pain of the lockdowns and nearly 1 million jobs disappearing. By the end of 2020, Australia's housing wealth was surging. According to the ABS, housing wealth skyrocketed by $501 billion in the last 3 months of last year, which was the strongest quarterly growth since December 2009. Wealth per person hit $467,000, and total housing wealth hit $12 trillion, both records. More than 900,000 people were still officially unemployed in December, and the unemployment rate was still 6.6%. So the question is, how could household wealth have been hitting record levels? Well, it's because wealth and income are very different things. When the ABS compiles its data on wealth and income, it uses an internationally agreed set of standard concepts, definitions, and classifications. Wealth refers to the economic resources held by members of a household after all their debts are theoretically paid off. Wealth is made up of residential property, the family home, superannuation savings, shares, and other financial assets like bank deposits, as well as other non-financial assets like cars and furniture and artwork, and investments in other real estate, that will be investment properties. A household's wealth can increase in different ways, therefore. It can increase when the estimated sale price of their home goes up relative to the size of the principal outstanding on their mortgage. It can increase when their super account grows. It can increase when their savings account grows. As you can see, wealth is a stock concept. It refers to the value of a household's assets minus the household's liabilities at a given point in time. Household income refers to all current payments received by a household that are intended to support or are available for current consumption. And for most Australian households, income comes from a few sources. It's wages and salaries, income from investments like superannuation or dividends from shares or royalties, government pensions and allowances like the age pension and job seeker. Less typically, income can also include inheritances, lump sum retirement benefits, and life insurance claims. When a country's household wealth is surging, it means that the value of assets held by households is rising. But, and this is a big but, if you don't own any assets, you're not benefiting. According to the ABS, the surge in wealth in the December quarter was driven by two main things: property price rises and growing superannuation savings. Property prices grew strongly towards the end of 2020. The value of Australia's residential property and land and dwellings jumped by $207 billion in the September quarter and $247 billion in the December quarter. ABS official says that Reserve Bank's expansionary monetary policy, particularly its historically low cash rate of 0.1%, and government support for the housing sector drove the surge in wealth for property owners late in the year. The recovery in stock markets also saw superannuation reserves increase by $166 billion in the December quarter. It means Australians' super accounts have now fully recovered from the losses experienced in the March quarter of 2020. If you didn't withdraw your super savings last year and extinguish them all under the federal government's controversial early super release scheme, there's a chance your superannuation wealth will have increased this year. And if you own your property wealth may have already increased because property prices have been rising since December. In fact, in February, house prices posted their sharpest monthly increase since August 2003. Last week, ANZ economists released new forecasts tipping national house prices to rise by 17% this year. But what does it mean for people who don't own a property? Well, in December, the Australian Council of Social Service, ACOS, released a report called Inequality in Australia 2020 Part 2. The report was based on the latest available data from the ABS for 2017-18 and presented a snapshot of income and wealth inequality in Australia in 2018. Therefore, it provided a baseline of data against which to assess the impact that COVID-19 and Australia's economic policies headings in 2021 will have on inequality in coming years. As the report points out, wealth inequality is a far bigger problem in Australia than income inequality. Even before the COVID recession, the highest 20% of households with average after-tax incomes of $4,166 per week had almost 6 times the income of the lowest 20% with $753 per week, said Professor Carla Triolo, Director of the Social Policy Research Centre at UNSW Sydney, when the research was released. When it comes to wealth, the inequality is even more stark. The highest 20% with average wealth of $3.3 million have 90 times the wealth of the lowest 20% with just $36,000 on average. The average wealth of the highest 5% wealth group was $6,795,000. Things get stark even more when you look more closely at the data in the report. In 2018 in Australia, the highest 10% of households by wealth owned almost half, actually 46% of all household wealth, whilst the lowest 60% of households who were younger and poorer owned just 16% of the wealth. Australia had the 5th largest number in the world of people with ultra-high wealth, defined as holding more than $500 million US or $654 million Aussie in wealth. Now, let's think back to the main components of wealth. According to the ACOS report, the average wealth per household in Australia in 2018 was made up of the main home at 39%, superannuation at 20%, shares and other financial assets at 19%, and investments and other real estate at 12%. Other non-financial assets was around 10%. Ownership of some types of wealth was very concentrated. According to the report, the highest 20% of wealth groups owned more than 80% of all wealth in investment properties and shares, over 70% of all superannuation assets, and 54% of all wealth in main homes. However, high levels of home ownership among retired people on relatively low incomes helped to make wealth holdings across income groups more evenly distributed. Now let's look at this unequal distribution in more detail. First, let's look at the plight of some students, those on job seeker and those in the rental sector, or in other words, how the other half lives. As one student gets out of bed, another gets in, and thousands are hotbedding in Australia, says the conversation. International students commonly share bedrooms so that they can afford the rent. What is perhaps more surprising is that our research suggests thousands are hotbedding. Their beds are available to them for only some hours of the day or night, so others can use them for the rest of the time. In a survey that they ran of international students who were renting privately in Sydney and Melbourne, and it's representative of the 758,154 international students in Australia in December 2019. That actually equates to around 22,750 students who are hotbedding. In their surveys, 3% of all students answered yes to the question, do you have to hotbed, i.e. your bed is only available for a few hours of the day or night. The survey also found about 4 in 10 of those hotbedding students were going without meals. And this was before nearly 2/3 of international students lost their jobs in the COVID-19 pandemic. Another extraordinary finding is that 14% of hotbedders said their employer had threatened them with visa cancellations, compared to 2% of non-hotbedders. 1 in 5, or 20%, compared to 5% of non-hotbedders, answered yes when asked, has the landlord or real estate agent or property manager ever taken away your passport? These findings suggest a sizable proportion of hotbedders are struggling financially and are in a vulnerable situation. Many said their circumstances were having a negative impact on their studies. And despite having to hotbed, just under 8 in 10, or 78% of students, said they were satisfied or very satisfied with the home they were renting. And just over 7 in 10, at 72%, agreed with the statement, the home I rent is suitable for my needs. Only 7% disagreed. And only 1 in 10 hotbedders agreed that the person they rent from did not keep the property well maintained. Just over 1 in 4, at 27% hotbedders, felt their home was overcrowded, compared to 12% of non-hotbedders. The cramped situation appeared to have a negative impact on their academic work, about 1 in 3, or 35%, agreed or strongly agreed that the condition of my accommodation has a negative impact on my studies, compared to 13% of those who didn't hotbed. Remarkably, just under 1 in 4, at 23%, hotbedding students answered yes when asked if the balcony of the property is used as a bedroom, compared to 5% of students who did not hotbed. A similar percentage of hotbedders and 4% of non-hotbedders said the garage is used as a bedroom. Most hotbedders reported that they had a good relationship with their landlord or real estate agent. Only 6% said it was bad or not very good. And close to half, at 45% of hotbedders, said the person they pay rent to lives in the same accommodation. It's unclear whether this is the actual landlord or a person who sublets the property. 2 in 3 hotbedders sensed they could stay in this rental property as long as they want to. And despite the seemingly good relationship of most hotbedders with their landlord, just under 1 in 3 agreed that if they complained about the standards of the property and maintenance problems, they might be asked to leave. Although maintenance did not seem to be a major issue, just under 4 in 10 hotbedders agreed that they were concerned the rent might be increased if they did ask for repairs, and 38% were anxious they might be told to leave their property and be given a short time to leave. And when asked in the last year, have you ever felt you could become homeless, 37% answered yes. This compared to 17% of non-hotbedders. And just under 4 in 10 hotbedders agreed or strongly agreed that stress around the possibility of losing my accommodation is affecting my academic studies. Half the students who hotbedded had paid work at the time of the survey, and of those employed, 48% reported that their landlord employed them, compared to 17% of other students in paid work. And a large proportion felt they were poorly paid and that their job was insecure, and less than half of the hotbedders felt they were well paid. Only 1 in 4 disagreed with the statement, my current job is insecure. And this chart shows 8 measures of financial stress adapted from the Australian Bureau of Statistics. They added an extra item on affordability of textbooks. On every measure, students who hotbed were 2 to 3 times more likely to have answered yes to the question indicating financial stress. Perhaps the most alarming statistic is that 39% of hotbedders went without meals. So did 20% of non-hotbedders. And 1 in 10 hotbedders suffered from all 8 indicators of financial stress. A worrying 34% of hotbedders reported 5 or more indicators of financial stress, and only 9% of non-hotbedders reported 5 stress indicators, and less than 1 in 100 endured all 8. And here's another question. What happened when you free unemployed Australians from mutual obligations and boost their benefits? Well, we just found out, according to another Conversation article. During COVID-19, the government ran what turned out to be a giant real-world experiment into what happens when you boost someone's unemployment benefits and free them of the mutual obligations to apply for jobs. On April the 27th, 2020, the government as good as doubled the $565.70 per fortnight job seeker payment, lifting it by $550 per fortnight for what turned out to be 6 months. In September, the boost dropped to $250 per fortnight, and in December to $150 per fortnight. Next Thursday, the boost vanishes, although the base rate of job seeker will climb by a less than substantial $50 a fortnight, leaving recipients $100 a fortnight worse off than they would have been, $500 per fortnight worse off than back when job seeker doubled, and back well below the poverty line. From Thursday, April the 1st, they will also be subject to much more demanding work tests, having to show that they applied for a minimum of 15 jobs a month, climbing to 20 jobs a month from July the 1st. On top of that, the government has announced a return to compulsory face-to-face meetings with job active providers, work for the dole after 6 months of unemployment, a dob in line for employers to report job seekers who do not seem to be genuine, and increased auditing of job applications to ensure they're legitimate. They are the sort of mutual obligations that were scrapped while job seeker was doubled. Yet the government's natural experiment, where they doubled benefits and freed recipients of mutual obligations, provided us with an opportunity to examine how a more generous approach affected recipients, and whether, as the government says, a tougher approach is needed in order to compel people to work. During last year's more generous approach, they conducted an online survey of job seeker recipients and found that, contrary to what appears to have been the government's expectation, it was helping get people into work. Freed of mutual obligations, many were able to devote time to re-engaging with the workforce. As one respondent said, "I was able to focus on getting myself back into the workforce." Yes, mutual obligation activities prevent people from being able to start a new business or re-enter the workforce as an employee, and the extra income freed recipients to do things that would advance their employment prospects, either through study, through properly looking for work, or buying the tools needed to get work. One said, "I could buy things that helped me with employment, equipment for online work, a bicycle for travel, a proper phone." An Australia Institute review of the unemployment payments and work incentives in 33 OECD countries found something similar, that higher payments correlate with lower unemployment. Another respondent said that the suspended mutual obligation requirements made it easier to care for an elderly parent during the pandemic and their recovery from major surgery. Another said she'd been able to focus on her health needs and her children. People on social security are often accused of being dependent on welfare, but it's often the economy and society that are dependent on their unpaid labour. Yet, except for during the worst of the pandemic, these people have been denied a safety net that ensures their survival. The inadequacy of payments goes to a major and enduring flaw in the Australian social security system: its inability to recognise all of the productive activities people undertake, including unpaid care, largely undertaken by women. The decisions the government took during 2020 made a major difference to the lives of people outside the formal workforce. They enabled them to turn their attention away from day-to-day survival towards envisioning and realising a more financially and emotionally sustainable future for themselves and their dependents. The flow and benefits to all of us ought to be substantial. The government ought to be very interested. If it was, it would examine the findings further, but they don't seem to be on the radar. And finally, at least 2.6 million people face poverty when COVID payments end and rental streams soar, according to the conversation. Many Australians whose jobs were decimated by the COVID business shutdowns will soon be waking up to a new income shock and the prospect of rental stress. This is because people whose employers can't afford to keep them on will suddenly lose more than $300 per week when the JobKeeper scheme ends on March the 28th. Worryingly, this income shock will happen just days before the payment to people on job seeker benefit are effectively cut by $100 a fortnight. At that point, all income support recipients, more than 2.6 million people, will be below the poverty line, and many will face extreme rental stress. This income shock has been anticipated for some time, but what does it mean for the rates of rental stress, particularly in Victoria? Despite promising signs of recovery, Victorian jobs lost to the COVID-19 induced recession, such as in the hard-hit business, tourism and live music industries, have not bounced back at the same rate of others. What will happen to rental affordability? Well, to illustrate the point, they modelled housing affordability for single people who were on either the full-time or part-time JobKeeper rate. In this scenario, they could also get job seeker payments at a part-time rate because of the temporary increase in the income-free threshold to $300. This made them eligible for Commonwealth rent assistance too. And the chart shows the impact on income and rental affordability when JobKeeper and coronavirus supplement payments end. Their incomes and the amount of rent they can afford are roughly halved. Full-time and part-time single workers were able to afford weekly rents of around $265 and $245 respectively before the withdrawal of JobKeeper. Afterwards, affordable rent goes down to $115 per week, and that's about $110 less than the $450 median rent, or $225 per person, for a two-bedroom share house in Melbourne. Based on earlier calculations, this leaves those renters with only $17.57 per day to meet basic costs. They have a lavish $3.57 per day, more than they did before the pandemic, to pay for food, utilities and job-seeking costs, such as mobile phone plans and travel cards. And by the way, that's $4.40 a day in Melbourne. What is different now than for pre-COVID unemployment was that business shutdowns thrust people who had reliable earnings and accompanying high rents and mortgages in metropolitan areas onto JobSeeker and JobKeeper payments. And this chart shows the change in rental affordability for a number of household types before the pandemic and during the coronavirus supplement stages, i.e. payments of $550, then $250, then $150. For example, when their income was highest during the $550 stage, two singles sharing could afford a rent of $430 per week. Once the supplement ends and is replaced by the $25 a week increase in JobSeeker payments, affordable rent declines to only $230 a week, or $115 each. Rental affordability for single-parent households is notable here because the COVID supplement was payable to one person only. Once the supplement is withdrawn, they will again be disadvantaged relative to other households because they will not be receiving the increase in the JobSeeker payment. So what sort of job losses can we expect? Well, it's hard to predict exactly how many people will lose their jobs when JobKeeper ends. What we do know is the economic recovery in Victoria has lagged behind the other states. We also know that at the end of December 2020, 1.55 million people were on JobKeeper, and a larger proportion of them, around 626,000, were in Victoria. Economist Jeff Borland conservatively estimates that national job losses could range between 125,000 and 250,000, and it's reasonable to expect as many as half of those will fall in Victoria. Their analysis also shows there are worrying signs that the economic recovery celebrated in the January labour force data was not sustained in February. The latest data provided to a Senate inquiry into COVID-19 shows that JobSeeker recipients increased by 7,267 between January and February. The increase in Victoria could be attributed to the temporary Christmas retail boom, but in states like New South Wales and Queensland, claims decreased slightly. While fewer people will lose their jobs in other states than in Victoria when JobKeeper is withdrawn, they are not immune to this income shock. Once the supplement's reduced to $250 per fortnight, singles and single parents with two children were below the poverty line. And when it was reduced to $150, the number of household types in poverty increased again. From April the 1st, all income support recipients, covering more than 2.6 million people, including children, will be waking up to poverty and the prospect of extreme rental stress. So how can governments prevent people from falling off the rental cliff? It's unlikely to be achieved by introducing cut-price flights to far north Queensland. A new range of strategies are needed. These include options advocated by ACOS and others to increase the maximum rate of Commonwealth rent assistance by 50%, increasing the JobSeeker base rate above the poverty line, and to introduce rental stress grants targeted at individuals who need more help. Over the longer term, there is also a need to adopt strategic approaches to increase the supply of affordable rental housing, such as those recommended by researchers at the Australian Housing and Urban Research Institute. So the point I want to make in closing is that all the talk about the wealth boost and prosperity rising only touches a proportion of the population. There is this soft underbelly of many millions of people in Australia who are being exposed, and yet the policies advocated by government appears to me to be myopically avoiding the real issues. This is a big problem, and I fear that over the next few months we will be seeing the consequence of this playing out on the ground. That's one reason why our rental stress numbers are still very high in our surveys, and when we update them next month, I expect them to be even higher. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.